Good morning. Welcome to another rundown for global stocks and commodities for the 11th of June. It was a pretty quiet week, all things considered, considering what was going on with the UK elections and the Comey testifying in the US Senate. But despite all that, markets remain calm. And the only real action of significance for markets came late in the session on Friday night with a sell-off in technology. But the other sectors certainly didn't follow. So this was really more about a rotation of money from a sector that had done incredibly well for a long period of time. And that's going to happen from time to time. It's inevitable. So let's take a look at the action last week. The S&P ended up falling by 7 points on the week, but as you'll see from the chart, still looks really robust, and the path of least resistance is still to the upward side. Technology, bit of profit taking, but as we shall see, there is nothing too much to be concerned about there. There was clearly a rotation of money came out of technology, so it wasn't coming out of the market altogether. It came out of technology stocks and it went into financials in particular, but also some parts of healthcare and industrials as well. So this is just normal sort of action, and you can't have sections of the market just continuing to barrel on because eventually the reversal will be even more severe. So this is good. This is healthy. There's been a question mark over the Russell 2000 lagging, so the small caps had been lagging technology. Well, certainly we saw the Russell 2000 actually go into a breakout. So from a consolidation period for quite some time and money rotating into small caps as well. So that overall, this is really healthy market action. So I want to take a look at what the NASDAQ decline might look like, what the signs are that we should look for, and whilst it's only half a session, what I can deduce from what we've seen so far. Now, the US dollar was marginally higher. It got down to oversold, so a bounce obviously was pretty likely. But let's jump in and have a look at the charts. So we'll start with the S&P, and you can see that basically we just track sideways for the week. And a little bit of volatility on Friday, but it managed to sort of regather its reins pretty well. So I think that we're likely to see the S&P push higher, although the drag from technology certainly won't be helpful. But look, I'm just not expecting anything of any real significance here at all. Turning now to the Russell, you can see that we had a period here of lengthy consolidation with a slight upward drift to it that started in December, so it'd been running now for about 6 months. And whilst it didn't really close to a new high, it certainly traded to a new high. So that's a positive when some of the biggest parts of the market were being sold off fairly aggressively on Friday night. Let's look at the NASDAQ now. So it's had an extraordinary run, as you can see. Let's go all the way back here to the lows of 2009. So the NASDAQ was down around 1,000 points. Now it's knocking on the door of 6,000 points. So it's been an incredible run. We had a period of consolidation after the last major move forward that ran from the end of July 2015 until the end of July 2016. So this period through here ran for about 12 months. And that was the range between roughly 4,800 and call it 4,000. So a consolidation of about 12 months. And it's possible that we might see something similar. I'm not saying that we will, because circumstances are quite a bit different with respect to technology now. But that could be something that we are looking at. So therefore, if that is the case, then you certainly want to try and buy the bottom of that range. You don't want to be jumping into this too soon, because if this does form a range of that dimension, and let me just go back to that Oh no, I won't do that. I might do that another time. So if we do get a range set up, and at the moment I'm looking at a 38.2% retracement as the first objective. So that would give me an objective on the NASDAQ around about 5,400. Now that may not be far enough, but for the first bit down, it may be enough. So my plan is to do a little bit of buying around this area here if it gets down there, and then just play it from there. If a bigger range sets up, then I'll play that accordingly. But the bottom line is that you want to try and trade with an edge, and the best way to get an edge is to be buying the bottom of the range and taking some partial profit at the top of the range. It's pretty simple stuff. Now, a couple of things that argue against a more significant fall in the NASDAQ. And a lot of individual stocks look the same. If you want to look at Facebook or Amazon or Apple or any of those major components of the NASDAQ, you'll see this same pattern. Whilst there was a sharp sell-off, there was also some buying. So there are buyers lurking around the market, there's no question. The second point is that there's not a great deal of change in the VIX. So let's just look at the VIX index. So we got a slight blip. I've got to a high of around 11.5, but look, really no change in the VIX at all. So there was no sort of panic selling at all. And whilst this was certainly a sharper reaction, I think the fact that money went into financials without any equivocation at all, went into healthcare and into some industrials, I'm just not expecting a great deal out of this at all. So that's the US market. The Australian market, the Aussie dollar rose to 75.3. That was partly because the US dollar went down early in the week. The US dollar did stage a bit of a turnaround, and we'll take a look at that late in the week. And we've now gone back to the top of the lower band, which I'll explain in a moment. The ASX 200 index fell 110 points on the week, very disappointing. And I guess the term sell in May and go away is valid for Australia, but really for nowhere else. The Australian market has been really quite disappointing during May, whereas England, Germany, China, Japan, US have all been trading very positively. So I think this is it's about lack of faith in our economy. And if you saw last week's video where I talked about the possible long-term influences on the Australian dollar, there really are an awful lot of boxes getting ticked on the negative side with respect to Australia. And I think that lack of faith is coming both from overseas investors that represent around 40% of our market, and also locally as well. So not good signs for the Australian market. And whilst there are a few possibilities, some good niche market opportunities which members know about, generally the Australian market is just hard work. So let me just take a quick look at the US dollar. So there's the US dollar. We've had a fair old decline, but we came down to close to a support area, and you can see Thursday and Friday it did tick back up again. So if we swing over to the Australian dollar, you can see that we can identify two bands here. There is a larger band which runs from 78 to around 69. So there's a bigger picture band, and then we can break the current market action up into some smaller bands. We had one of them in force for a period of time, and that was between roughly 75 and 77.5, and we now seem to have dropped into a lower band, although we did poke our head out the top of it, as you can see, but I'm always forgiving of a little bit of overrun. I think we're now spending more time below the red 200-day moving average line and in this lower band. And the longer term direction for the Australian dollar for me is clearly down. Not much question about that. Let's just look at the ASX 200. So if we look at what we've been able to achieve this year or not achieve, so let's go back to the start of the year, which is here. So there's the start of the year right there. So we're actually trading down. We're at around 57, about 57.25 at the start of the year, and right now we're trading at 56.77. So yes, we spent a fair bit of time above it, but we've given back all those gains and some. But if you look at the German DAX, since the start of the year, it's gone from 11,500 to nearly 13,000. If you look at the FTSE in the UK, it's gone from around 7,200 to about 75, 7,600, despite all the things that have gone over there, despite Brexit, despite the UK election debacle, the market has managed to go higher. If we had things like that in Australia, I'm sure our market would be a lot lower than it is at the moment. Precious metals. Gold got up to resistance at 1,300 and then turned back down again, failed to break through that key resistance. And look, to a degree, that was pretty much expected, as I covered last week. And we'll revisit that chart, which relates what gold does typically going into the Fed announcements on interest rates. So gold fell by $12. It had been a strong week. That give back was only towards the end when it got up to the 1,300 resistance. So for me, it was a combination of currency. The US dollar turned up late in the week, as we saw. The Comey testimony, which is really just shaping up as a complete non-event. This is just a media beat-up as far as I'm concerned. A lot of the media, I don't agree with Trump on several things, but I've got to agree that the media is just plainly out to get him, and no more so than the New York Times. And this whole Comey thing is just an absolute media beat-up in my view, and that's why markets are just completely disinterested in it. Importantly, gold does tend to react around the Fed meeting, and we've got one coming up this week, and so a further decline in gold is quite likely. But I think largely this was around technical factors. We got up to 1,300 resistance, and we're pulling back. So normal sell-off into rate hikes. This is what I had last week, targeting 1240-ish. I don't see any reason to change that. Now the futures market, we saw a massive increase in long contracts in the futures. 50,000 contracts were added. That's one of the biggest weekly additions to the long side in many years. Now bear in mind, these numbers on the CO2 report relate to up to Tuesday, so there is a 3-day lag in these numbers. But it's pretty typical. You get a massive build-up on the long side amongst speculative futures players, and it gets overheated, and then the smart money moves in and down she goes. So it just keeps playing out over and over again. Interestingly, in the ETF market, though, buying into GLD has continued. It remained solid during the last sell-off in the gold price. There wasn't a sell down in GLD, and that's what makes me quite bullish about gold in the medium to longer term. The GLD, the people who are investing in the ETF, they're longer term players. People in the futures market are really short-term players. They kind of light the fuse, but they can't sustain a rally. The amount of money is just not big enough. The rally is sustained by buying in the physical market and in the ETF market. And the fact that the ETF market failed to sell off during the last big dip in gold was a positive, and it's continued to build on that, and we're now back up to 867 tons. So medium to longer term, these are all positive signs for gold. And I think the chart patterns are very interesting. Precious metal stocks, buying the dip looks good. However, we might still be a few days early. I would probably not do anything much until the Fed meeting, where we might see a low in gold and gold stocks. And the other thing to remember, of course, is that gold stocks are at historic lows relative to gold. If you look at that ratio, it should be at least double or triple without the gold price moving to get back to the long-term averages. So if you're looking for longer-term reversion to the mean, then there is a massive one right there staring you in the face. Okay, let's take a look at gold and silver. So we'll start first of all with the weekly chart. So here's our bigger picture triangle that's set up, and you can see that we had resistance here at 1300. It got to a high of 1297 and turned back down slightly. So that's all consistent with the bigger picture. But I think eventually, for all the reasons that I've just gone through, we're going to see a breakout of this big picture triangle, which really started back in 2011. So this is a 6-year formation in the making. So it could take a while longer yet. Now let's look at the daily. So this was the chart I put up last week. This is what happens. The green rectangles represent the rate hikes. December last year, March of this year, and possibly this week coming. And into each one of those rate hikes, we've had a sell-off. And then immediately the announcement's made, the gold price moved higher quite sharply. So if we got another 3-day sell-off down into this zone around the 1240 mark, that would be a perfect setup. Let's turn to GDX. So there is GDX. Now I just want to take a bigger picture look here. So this is the peak in GDX in 2011. So it peaked out around $66. We then went into a massive decline that bottomed out. We got a real selling climax. You can see the big spikes in volume here. See those big red spikes on the volume there? That was the real selling climax that marked the lows, and that was down around 13.3. And that occurred in July of 2015. The market then formed a base. We got a little false breakout here in January of 2016, and that proved to be the ultimate lows. Now, if we put a big picture Fibonacci scale from these lows coming off the 2011 highs, then we find that 38.2% rebound came in at $33. We didn't quite make it. We got to 31.78, but pretty close on a big picture level. So that was a good point for the market to turn back down again. And I do point out that this rise here from the start of 2016 to the middle of 2016 was the strongest and fastest rebound into a new bull market in GDX ever been recorded. So that's significant. And we broke all these highs. So broke all these highs all through here. So very, very positive action. Now, after such a record-breaking run, it's not surprising that we're getting a bit of an extended correction because there was some really massive excesses got built up. So we've actually pulled back to just a fraction below that. So I'll tighten this in now. So we certainly had some meaningful rebounds on good volume coming out of these lows. Now we've pulled back to just beyond the 61.8, again bit of a false breakout, and now we've now started forming another triangle, and I believe that triangle will resolve to the upside and eventually will break above $32. So for shorter term traders, I think the opportunity is to look at buying into GDX somewhere around 22. This may not be ready to break out yet. But buying in the bottom half of this triangle and perhaps adding to that on a breakout of the triangle would be a pretty reasonable strategy. Now I'll just see if I've got this. I've got this spread. Yes, I have. Okay, so this is the ratio between. I'm using the HUI index here, not GDX, but it's all one and the same thing. So this is the ratio between the HUI gold stock index and the price of gold itself. And if we pan back, you can see that long term, there is a long-term average. It's arguable where you put this line. Some analysts I've seen have got this line more around the 30.35 mark. In other words, the gold price is 3 times the price of the gold stock index. Or you could argue that it could be up here more around 45, 46, which is more of a long-term average. But whichever it is, we're currently down at 0.15, which means that we're at least at least half to a third undervalued on gold stocks compared to the long run average. So that means that gold stocks could double or triple without the gold price necessarily needing to move to come back to long-term valuations. So that's the situation with gold. So I think a good medium to long-term opportunity, but not sure that we're quite there yet. Turning to other commodities, copper was a little bit higher despite the US dollar going lower. So it seems to have disconnected from the currency to a degree. Crude oil dipped sharply again to finish at 45.80. And this is what I had last week, a target of 42 to 46. So we're certainly now down into that target range. Now, it was interesting that oil stocks did steady at the finish of the week. Despite this big sell-off in oil, gold stocks didn't really go with it. So this could be the start of some promising reversals. And if you look at the XLE, it was just a textbook 50% retracement on XLE, which is the overall index for the energy sector, right to support and 50% right on the money. So this could be a buying opportunity into the energy sector. There's spot copper, you can see, has kicked up a bit during the week, and there's crude oil that you can see slid back very sharply, formed a slightly new short-term low, and then, as you can see, turned up just a little bit at the end of the week. So to wrap it up, the current positioning, just ignore the scary stories. There's so many of them out there. They're just media and commentators trying to sell stories and build reputations. Just ignore it. It can only do you harm, I believe. The thing to focus on, the only thing that you should focus on always, is corporate earnings and the global economy. Investing is a lot simpler than what the media would have you believe. This remains a buy the dips environment, but only where earnings growth is occurring, which means you've got to do your homework on the fundamentals. Critical. Technology remains the big long-term story. There's no change there. Whether we get a sharp sell-off and a bounce like a V shape, or whether we get an extended consolidation that could last for 6 to 12 months, we have no way of knowing, but the next few weeks will give us a lot of insight into how that's likely to play out, the size of the daily ranges, the volumes that are associated with them, where the price finishes in relation to the close, are all indicators that I'll be using. Financials, industrials, and healthcare are seeing some rotation, so there could be some reasonable short-term trading opportunities there, if not necessarily longer-term positioning. Resources could be accumulated on significant dips, but I would definitely preset a maximum exposure limit for each sector of resources. And remember, resources are volatile, they're unpredictable, and they really should form a smaller part of your portfolio. And I think tentatively oil and gold stocks from oversold at the bottom of ranges, I think, provide some opportunities. So that's the rundown for this week. A lot to go through. There's my contact details for anyone who's interested, who's not a member. And I guess the big event this week will be the Fed and interest rates, and I'm sure markets will be hanging on every word about not so much the rate rise, because I think the rate rise is probably extremely likely it'll be the wording that goes on from there, whether they want to paint a more aggressive picture in raising rates or whether they're going to be a bit more dovish about it. So that's it for this week. Cheers.